Howdy, Jacob here. Today we're looking at Coursera in the diversified consumer services industry. 1.2 billion market cap on 532 million enterprise value. I just did a deeper dive and reviewed Chegg, so I kind of want to do quite a little bit different than what I usually do. I'll probably start off pretty normal and then I'll finish by comparing the two. So right now we do have a 1.2 billion market cap and 532 enterprise value versus 234 million market cap, 131 million enterprise value. The revenue growth is much more substantial, at least recently, with Coursera, 184 million in revenue in 2019 to 636 million in 2023. Chegg went from 411 million in 2019 to 716 million in 2023 with 2 years of declining revenue. Gross margin in the 50 to 60% range, but negative operating margin. Chegg has slightly higher operating margin, 60 to 70%, so a little bit higher, and have historically produced an operating margin. Their return on invested capital doesn't exist because, again, they don't have profit. So on the income statement side, we do see a large increase of research and development. And in fact, the last 2 years, there were a couple of years where if you remove the entirety of R&D, you do get a positive operating profit. But again, that would have dampened and diminished their growth. And so R&D is taking money away from today to hopefully get more revenue, bottom line efficiencies in the future. So not all those bets are going to pay off, but it is good to see a growing company reinvesting back in themselves to try to get more growth, to become more efficient, to find ways to better their business. And here, even with the R&D as high as it is, they would still barely make a profit. Whereas when it came to Chegg, their R&D was much higher than their operating profit, so much so that if you just cut their R&D in half, you'd be making pretty substantial 10% plus operating profits, which we're not seeing on Coursera yet. But again, Coursera is still a growing business, and they are growing much more than Chegg, at least the last 2 years, definitely. Balance sheet, 656 million cash and cash equivalents, a little over 700 million cash-like products. No short-term debt, no long-term debt. I love that. They have more cash on hand than all their total liabilities, not even interest-bearing, all their liabilities. That's fantastic. Chegg is a little bit different. This is something that I really wanted to see this 357 million figured out, and then the 243 million is not a big deal. But when debt becomes due in the next year, you get a little bit concerned because there's really only two things you can do with it. You can either pay it down or you can let it become due, or I guess three things. You could refinance it, or if it comes due, that's when problems occur. And this is a different type of debt. It's not necessarily what you'd think of. This is a debt where they do owe 357 million or shares outstanding. And so from my understanding, it is one or the other depending on the share price. And with the share price going down so much, they just owe the $357 million, which again, they have pretty much that in cash at the moment. And they do produce a lot more free cash flow than the income statement side. And Coursera is similar, where they have produced, at least the last 2 years, good amount of free cash flow for not producing any net income. And so a lot of that is due to stock-based compensation. So they are issuing shares or have the options to issue more shares to their management board. Management, likely CEO, CFO, all the big dogs of the corporation. But they did sell off a few investments, over here. But still put it into cash. Balance sheet, beautiful. I'm just a little questioning of the margins here. So if I were to make my assumptions, I think I do like them from a growth perspective better than Chegg. So for Chegg, maybe I did a couple percent. For Coursera, maybe, and this has really been mostly organic. I feel like they can grow 12% a year. I feel like growing 12% a year We just don't know the margins yet. So I'm going to have to get an increased discount rate because I'm going to have margins that are, let's do 5 to 10. We're doing a big range because they haven't really produced margins yet. So we're creating a story that says maybe they're similar to Chegg and they produce margins that are similar-ish on the operating and free cash flow side with share changes of their stock-based compensation of 100 million, but they buy back half of it, so about 5% issuance of shares. And we're saying the company's stock price needs to fall 73% before you get the return we're looking for here. To me, I think if I were to compare the two, just look at Coursera and Chegg, no other companies existed. I can't say whether I would for sure pick one or the other because right now I do think that you're really egging on and expecting a lot of growth when it comes to Coursera. And can they produce that with similar margins to Chegg? Definitely possible. I think that that's definitely a possibility, but is it likely? And that's where I get a little skeptical. And when it comes to Chegg, to me, that short-term debt is enough to, scare the heck out of me. I think that I really want to see them have more cash on hand than that 357 mil. And then maybe, after they pay that off and they only have debt due beyond 1 year, I'll feel a little bit more comfortable to invest with them. I do think that Chegg is a bit cheaper. I mean, even just market cap wise, 1.2 billion versus 234 million with the same revenue essentially. In fact, Chegg's a little bit higher and with actual margins, which on the free cash flow side, again, they are showing free cash flow margin of 5 to 10%, depending on if you're looking at last year versus rolling 12. But Chegg is also over 10% on the margins, on the free cash flow margin side. So to me, I think it's interesting to look at two businesses that are similar. I don't think it's always one versus the other. I think you have to look at businesses that you understand, and then from that entire scope of businesses that you understand, then you can narrow it down. But I do hope you found it interesting for me to just review two similar companies. Again, I think there's pros and cons to each of them. I don't think there's an obvious one investment choice. But I do hope you enjoyed the video, and I hope you have a fantastic rest of your day. Thank you.